everyone. Thanks very much for coming back post-lunch. So now we're going to hear from Evenlode, who managed our global equity portfolio, one of them. That's James Knoedler, who is co-portfolio manager on the fund, and Cristina Dyer, who is a dedicated analyst on strategy. It was their love of quality investing which attracted both of them to work for Evenlode. And if you're wondering why they both look so calm and fresh-faced, it's not just because they're picking quality companies which don't keep them up at night. It's also because they live and work in one of the most beautiful parts of the country, which is called the Cotswolds. So they don't have to deal with angry Londoners every morning on their way to work. So I'm going to pass you over to James.
Good afternoon, guys. I'll do the post-lunch slot. And thank you very much for having us in. Really appreciated. As Jade mentioned, we work at Evenlode. I'll talk to you a little bit about who we are, what we do, and we will make reference to the theme of the day, which is artificial intelligence, and how what we do interacts with that. And I'll try and be crisp and leave time for questions. So I'll be very, very quick on all this stuff. And if I'm going too fast, please do ask questions afterwards. So who we are, we're, as Jade mentioned, we're based in the countryside. That's not actually our office. We have been around since 2009. A little bit about us, we manage about $7.5 billion in 3 strategies. We are very much long-only concentrated portfolios, and I'll talk a little bit about our philosophy and our process later on. And the thing really we'll get to later is our ownership structure as well, which is, I think unique for a boutique. I've been on board since 2020, and as mentioned, I co-manage the global equity strategy, which Cristina works on as well. And very briefly, what we do, we have a definition of what we count as quality. We'll get into that in a moment. We look for companies which can compound over time, and we look to manage risks. Well, today is all about risk, upside and downside, and we look to manage valuation risk very importantly. We believe that investment outcomes are price sensitive. And this is the nub of it, really. And the point is, when we define quality, I was just talking to Gary here about the academic research on this. People like Eugene Farmer, the factor research that people like Farmer and Asnes have done. Our definition is very qualitative. We say it's a high return on invested capital, but more importantly, it's your ability to keep that return on invested capital high for a long time. This is what's called a Sankey diagram, and it shows you that your starting ROIC is not particularly differentiating for your performance. The 2 buckets, and this is a persistent finding over time, high ROIC and low ROIC, if you took the whole bucket at the outset, they have very similar returns. What differentiates them is your ability to keep it high over time. And the signals for your ability to keep it high over time are, in our experience, primarily qualitative, and that's where we spend our time. And what we're going to do now, just to level set what we're trying to achieve, is talk to you about 3 different ways, 3 different types of risk we look at, and with specific reference to artificial intelligence. Just to level set at the start, when we think about artificial intelligence, our guiding assumption at this moment, and we're very data driven on it, is that it is not fundamentally going to revolutionize the world we live in. It is another extremely powerful, extremely dynamic technology, but there have been similar bouts of innovation going back to the Industrial Revolution, the appearance of computing technology, of the internet. This is an intensification and amplification of these, the ability to apply computing to problems. So we're going to think it's going to make some things radically cheaper, faster, more efficient, but we don't think it's going to fundamentally revolutionize industry dynamics. So if you're in an industry which has historically struggled to price through and capture excess returns on capital, it's going to be probably table stakes. So to give you an example, there's a lot of application already to consumer service, to customer service. And the idea is we're going to radically slim down our customer service centers and replace them with chatbots. Our expectation is this will take place over several years, but the benefits are likely to be competed away. We can't see how structurally this has changed those industries which are very dependent on customer service to enable them to capture those excess returns, thinking about, let's say, airlines, telecoms, etc. Likewise, it will probably improve credit scoring radically, so you can underwrite better, in particularly in consumer, where you've got bigger masses of data to work with. But historically, it's been very difficult if you're in financial services to capture the upside from better underwriting. It tends to be competed away. So that's sort of the throat clearing part. We'll talk about how we, going from the base of the business, the fundamental structure, which is the people and the way we're owned, the way we manage risk there, then into the process, and then into the way we assemble our portfolios. So just to start off with on business, the things really to get across here is that, look, artificial intelligence is really powerful where you've got lots of compute, lots of data. At the level of how you structure your firm, we think the same principles apply today that would have applied in the days of the rotary telephone and the slide rule. What's really important is that you get the right people, you incentivize them the right way, and you create it as a long-term partnership which is clearly aligned with your clients. That held true 100 years ago, 200 years ago. We think it will hold true in 100 years' time. So having a perpetual mission, I think it is a perpetual mission. We don't know when our clients will want us to stop managing their money. We assume it's, as long as, we have to assume it's practically indefinite, and a necessity of reinvesting. And one of the key areas you reinvest in is people. So one thing we've done, which we really want to stress, is that we are owned by a trust, and the trust's beneficiaries are the current employees, all the people on that screen. This is similar to the big UK retailer, John Lewis, which you may or may not know. And what this does is it means we are less, we're not open for sale, because a majority of the employees would have to vote for it, and we'd have to break the trust to be very onerous. And we're incentivized to keep on investing in people and systems. The other point is that in any partnership, it really helps to have a diversity of thought and a diversity of experience. And again, we don't think anything about innovation has changed that. That was the case 100 years ago. It will be the case in 100 years. We are technologically enabled. We have our own proprietary research management system. So we have 5 full-time technologists, coders in our team. With that being said, at the level of an AI enablement at this point is relatively low. We are not dealing with giant volumes of data here. It's a qualitative world we live in. Data are scarce, and that's part of the value we provide. What we do have is a good base that we can apply it to over time. And final point is really, because we were started in 2009, we had a pretty clean sheet of paper to work with, so we could start by saying we want the right ownership structure, we want the right technological enablement for sharing data and making it available for all decision making. And we also want to have a structure which is designed from a clean sheet of paper, so it's very clear how we're set up. The first decision we make when we're building our universe and our portfolios is on quality, and we'll get into that in a second. That is completely upstream and discrete to the decisions around risk management, which are based on idiosyncratic business level risk, which cannot be diversified away, and then valuation. So it's set up in a compartmentalized fashion so that we don't have. So one issue, I've always had with building quality value hybrid portfolios is what is driving the truck. And we want it to be really clear that quality is the overwhelming gating criteria. Everything else is downstream from that. And having that laid out that way is super important to us. So that's the first leg, and maybe a little bit now about the process, if that's an appropriate moment.
So we are bottom-up fundamental investors, and we want to invest in companies with strong fundamentals. What that means for us is finding companies that meet the 6 criteria around this slide. So from a numbers point of view, it's not going to come as a surprise that we want companies that are profitable, they're not highly in debt, and we have an additional asset light requirement. This side of the wheel is fairly straightforward. It can be easily automated. Anyone here can get their phone out and ask ChatGPT to give a list of 50 companies that meet this criteria. The question for us is, once we identify companies that have these historic metrics, how do we make sure that they stay in that top green bar that James showed, and they don't take the red escalator down to produce low returns for shareholders? And that's where qualitative analysis comes in, and this is where we spend most of our time. The really important bucket for us on the qualitative side is the durable competitive advantage. So what is it about the company that we invest in that makes it unique so that it over-indexes in the market growth? And of course, the competitive advantage is only as good as you can sustain it. We're looking for evidence that the company is sacrificing profit margins in the short term to generate those incremental returns into the future. And like James said, our fundamental bet is that generative AI is not going to alter industry dynamics. If I make a barrel of oil and James makes a barrel of oil, and then one of us starts using AI to get a cost benefit in our production process, the other one is going to soon adopt it. So any cost benefit that we get is going to be competed away over time. Where we think generative AI is going to be a benefit is in companies that already have an established, strong, sustainable advantage. So, for example, companies with very strong proprietary data sets. And two names that we have in the portfolio are Relics and Wolters Kluwer. They're both data service providers. They provide data and information for professionals, so doctors, accountants, lawyers. Every time they want to make a decision, they will need to use their data set into their workflow. And really is a pain in the neck if you try to switch out of these providers. So it's not worth the hassle. Gen AI for them is an addition, is not a replacement of the product set. If a competitor simply has a language interface and is not powered by the actual asset that provides the value, it's not going to make a difference for their clients. And from our channel checks, talking to management and the clients, it seems that it's going to take a long time for things to change, for workflows to adapt to the new technology. However, fundamentals change, and they do change. So the way we monitor changing fundamentals over time is through this checklist of 9 risk factors. This is presented as a radar chart. It looks a bit like a 50p coin, except it has 9 corners, not 7. I couldn't think of a coin with 9 corners. But what we're trying to do with this is to spell out how the fundamentals can change for the worse or for the better. And we scored this on an alphabetical scale. It goes from A, which is the highest score, to E, the lowest score. We're not trying to be overly precise. That's also a risk. But it's a qualitative judgment, and we're not trying to force it to be a quantitative judgment. And if you think of a company, let's say L'Oreal, French consumer giant, and how you would score it around this chart, in our assessment, we think L'Oreal scores very well. It's almost a perfect score. There's a little bit missing in the shape. And overall, we give L'Oreal a 7.5 maximum position sizing. So that means that if the valuation of L'Oreal is very compelling, we would own a maximum of 7.5%, and we wouldn't go above this. We use this checklist to monitor the quality of every single company that comes into our investable universe, and also, as an example, L'Oreal, to decide on the position sizing. Contrasting L'Oreal with one of the companies that was highly debated around generative AI, so Alphabet, the parent company of Google. We also score Alphabet very well on this metric, but the shape is a bit more narrower. It's more of an oval than a big circle, and that's just to account for the exposure to advertisement revenues and a bit of cyclicality there. Almost for 2 years, we've been doing a lot of work on understanding if the competitive advantage of Google is going to be eroded away by generative AI. And we've done a lot of talks with industry experts, looked at data sets, looked at the data that came out of the Department of Justice antitrust trial against L'Oreal, against Google. And what we found is that the fundamental click and query data of Google, it's not being altered by generative AI. That treasure trove of data that they have, it's still going to power them to have the next iteration of the algorithm that is going to allow them to take advantage of the generative AI trend. So whilst our research has uncovered a changing potential tail risk that has increased, we have adjusted one of this risk scores to reflect that. So the long-term industry outlook, we've adjusted it from being an A to being a B. So just incrementally reflecting that increased probability of the tail risk of Google. We still have a large position in Google. And that's because at the time when we did this research, the company looked very compelling from a valuation point of view. And we had a lot of headroom to our max position. So since the beginning of 2023, we've increased our position in Google. So we are quality first, but valuation second investors. And I'm going to hand back to James.
Christine. All right, guys, this is the home stretch. The valuation, and I think I said earlier that the contention is that your investment outcomes are valuation sensitive. This is like a nonce example. If you looked at lots of other situations, Nifty 50 in the early 70s, there's like loads, right? You can get lots of situations where the fundamentals stay pretty good. And this is not just a tech example. Walmart traded up tons because space growth is crazy in the 90s, right? They're growing like for like, so growing space. There was a huge TAM, right? It's a chart we've seen lots of times. And what we've done is tried to cut off the chart around where they took out their previous nominal high. Clearly, if you assume a cost of equity capital is like 6% per annum, just whatever, somewhere in that range, you have to run that chart forward quite a long way forward, even at parameters, until you have achieved a 6% compounding from the entry position if you manage to buy at highs. And you can do the same. Someone's done some pretty interesting work on the US equity market. It's replicated by the world. You can have situations where you buy for 10 years, you have pretty poor returns if you go all in on 1 year. And there's work by Edward Macquarie which looks back 180 years. I won't belabor the point. The idea behind it is that you have to be thoughtful about price when you go in. And we've always been run this way. It's 15 years now, and it falls back on a longer body of data. Now, there's some other slides in the chart. I don't want to go into onerous detail. The point we want to make is that we don't use like a price earnings ratio or a free cash flow yield per se. There are issues of those. Cristina touched on how we think about those three dark blue slices of the pie: your reinvestment, your competitive advantage, and your underlying market growth. You need to incorporate thoughts about them into your valuation. And what we do is, in essence, I won't bore you with the hijinks, it's a reverse DCF. And what we're looking at, so what we do is we work out what a company's compounding should be over time, incorporating thoughts about reinvestment and underlying market growth. Essentially, the reinvestment gives you information on the durability of the competitive advantage. And you try to be economical and elegant with your assumptions. You don't want to be building in really complicated models. It should be simple. And what you get from that, a set of signals. Actually, I'll show you an example where you're saying time to push, time to pull back. So Hermes is traditionally a very expensive stock. It's traded at big premium to the CAC 40, to the SXXP, to the world for a very long time, even to its peers in luxury. And we had signals to push in a bit more, and you can see how our position sizing has come and gone. We built a very large position in mid-2022 where it was about €1,000. The point is that we had to have a valuation system which rewarded them for some of their actions, right? And what they've done over time, they have deliberately restricted the supply of their stock to the market by quite a remarkable degree. They've shown enormous restraint, and that's a key area of reinvestment. Also, importantly, it's very hard to analyze it quantitatively. It doesn't show up in your P&L, the fact that you're holding back so much stock. You have to analyze other data sources. For example, the fact that alone amongst large handbag manufacturers, their handbags tend to trade in the second-hand market at a large premium to the first-hand market. You have to look at the fact that their gross margins are quite similar to their peer LVMH fashion leather goods, despite being much higher spec and much higher price. They're putting a lot more into the bag, and they're being more restrained about what they're asking for the bag in the primary market. So these are quite subtle signals. They're also, sorry, I should add, they're not growing their space. They haven't added to their store count really in the last decade, whereas large peers, even the highest quality, are growing stores by about 4% per annum. And that's an index for the volume growth and the increasing ubiquity of these products. So these are signals that you want to incorporate into your valuation. You can be valuation aware even when you're investing in companies with high price earnings ratios. These are also signals that push you out of companies with low price earnings ratios, but where they are selling the farm to make numbers. And they're mining earnings in 5 years' time, 10 years' time, 15 years' time for the benefit of today. So we can go into this another time, but the point is that you need to be conscious of these different signals, and they apply for every company, for every industry. They're very, very important right now. We're very mindful of them. And yeah, I think I just want to wrap up by saying what we've gone through, hopefully got a sense of how we are conscious of, one, the attractions of equities over the long term. There's a big body of evidence today. If you can get in equities and stay disciplined and committed to them, you and your clients will have a very good outcome. That being said, there are risks. You need to be conscious of, in our line of work, getting the wrong company, being wrong with your value assessment, and two, getting the right company at a wrong price. These are two things that we think about intensely, and underneath them, we have a discipline about the way we manage our company, the way we hire our people, the way we invest in research and technology, and that's all about creating that alignment. And we think if you select the things you're managing to and keep them simple, stick to them, tell people about them, revisit your assumptions as well, to the point about, we are conscious of keeping an eye on what's going on with AI. Sorry, Hermes is not particularly AI relevant, but there are lots of companies we look at which are highly AI relevant. It's to keep those channel checks, look at data which are often scarce, hard to access, hard to digitize. There's a lot in there for an active manager, but precisely because they're so hard to systematize. And if we have that sense, we've always had that sense since our foundation of that's being our discipline, we are optimistic about the world that's ahead of us. Probably want to wrap up there. If people have questions, please do ask us or grab us afterwards. And thank you very much on behalf of everyone at Evenlode for your time and your interest.
Would you mind just going back one slide?
Yeah. That one.
We have the 4 examples. Sorry, that's...
Yeah.
There we go. 2 questions. The first one is, did you include the effect of dividend on the share price in these graphs? And then secondly, which ones of these do you hold or not, and for what reason?
Sure. Yeah. No, this is nominal. Couple of them haven't paid a dividend in that period. But yeah, you're right. TSR will be slightly different to nominal return. But even, mutatis mutandis, you're still going to be underwater for a hell of a long time, right? But no, you're right.
Because when Microsoft paid somewhere with their dividend yield probably ranged between 1% and 2.5% over that period. Amazon hasn't paid a dividend.
Yeah.
Walmart is about, I think, 1%, so probably not material. I don't know about Cisco.
Yeah. No, take your point. We can show TSR as well, but I think the holding remains robust. That, you can be waiting a very long time, 8, 9, 10, 20 years, for a business to grow into an excessive valuation. You're absolutely correct that, this was done on the sideline from my day job. But you're absolutely right. I think and it depends on horizon, but particularly when you take that 6% cost of capital, you're asking a lot of anyone, even Warren Buffett, to sit and wait. But you're absolutely right. And then of those two, we actually hold Microsoft and Amazon. And Amazon we bought in 22. Microsoft we've held from inception. we are very conscious that their free cash flows are going down, particularly Microsoft's. Now, our valuation model, so I should have said, there's this problem with free cash flow because you're taking out discretionary key free cash flow, so naughty for doing that, but it's fine if you then spend it on M&A. You want to level set it and get to what Buffett calls owner earnings, right? So it's capital structure neutral after ESOP, but before discretionary. So we reward people for discretionary cash flow, CapEx, but there's a ton of it going on right now, so that is an elevated risk. Going back to the radar chart, cash generation is on downward watch for sure. Sorry if that was too full, but thank you very much for the questions.
Hi, how do you determine the number of quality firms that you would include? And is that done on the basis of a particular threshold of your assessment of that quality, or do you target a particular number of organisations when you're constructing?
Yeah, that's a great question. Our finding is that typically there's just not that many companies which fit in to our definition. I think we track about a couple hundred across our strategies. We have our two, I should have said, our genealogy is historically in income. So we have quite a lot of companies where the income is attractive enough that we can, when we're optimizing for four things, because we've got that chart, there's three things we optimize for. With income, there's a fourth. But basically for this strategy, there are fewer than 200. We would like to be relatively diversified. We typically look to have about 30 holdings. There is not a science to how we determine exactly how many, but there's a rule of thumb, which is, your 31st idea or your 32nd idea, right? There's a diminishing marginal outcomes. Position sizing, hopefully this is sort of getting to it. Position sizing is very much driven by those idiosyncratic risk pieces and then by valuation. I mean, you could run this with 10 stocks, but then you'd be asking your clients to stomach much more vol. You could, I think when you get upwards of 40 to 50 stocks, you're really, I think I would feel myself turning very beige, There's a right level of differentiation. We're 90% active share, right? So you will have a high active share. You don't want your clients to stomach too much vol. And do you see what I mean? Like 30 feels right, and we think we've got a nice diversification by category, by end market, etc.
Thank you. From an earlier slide, you can see that your team has a very diverse backgrounds: immunology, theology. Yeah. So, what are the risks that you're seeing that keeps you up at night, or?
Yeah. Risks that keep us up at night. Yeah. Sometimes I have 3 children under 3, so there's not like a ton of sleep at the moment, but it's not the portfolio per se. Yeah, I mean, look, going back to AI, I think probably just say like there is an upside risk to AI, which is AGI, but I think preparing the portfolio for that is like preparing the portfolio for nuclear war. Like, if it happens, all bets are off. We have infinite, abundant processing power and innovation. I think we're in a very different economy. And I don't think people are going to be that bothered about their 401ks or their ISAs, right? But stepping back more realistically, concerns that keep us up at night, there's lots. I'd say one worry is definitely we're in a situation which always worries us a bit, where earnings estimates are doing one thing and cash flow estimates are doing another for a lot of companies, right? And if you're a cash flow centric investor, accrual earnings running ahead of cash flow earnings gives you the heebie-jeebies. Limits to innovation in categories is always a worry. And I think there is a lot of people are rehearsing that worry right now about consumer staples in particular. Staples are probably slightly less worried about, again, based on the work and the channel checks, but you have to be respectful of that. I think history shows that a lot of categories are great and then they hit a limit to their innovation opportunity, and then it's like a bug hitting a screen door. So that's something you got to. So that's going back to what creates risk. The primary one is the assessment of the business's quality is wrong, and that's the real permanent loss of capital thing. And then valuation to a lesser extent, the one, that screen I showed you, that's like outsized valuation risk. That was like a proper 3 standard deviation or whatever event in 2000. I don't know how many standard deviations Gary will know better than me, but you know, that it can cause loss of capital as well. So hopefully that there's lots of company by company. Definitely overbuild of compute is something I'm conscious of, and we are exposed to it. Everyone is in the market pretty much right now. And then, yeah, limits to innovation, fatigue by the consumer, that sort of thing.
Any more questions?
Thank you.